Difference between dovish and hawkish banking policy. The terms dovish and hawkish have their origins in the world of diplomacy and military strategy but have been adopted into economic discourse over time. Dovish policies emphasize fostering economic growth and reducing unemployment, often through lower interest rates and more accommodative monetary measures. Hawkish policies, on the other hand, prioritize controlling inflation and maintaining financial stability, typically through higher interest rates and tighter monetary measures. Dovish policies are fundamentally aimed at stimulating economic growth. Central banks adopting a dovish stance often lower interest rates to encourage borrowing and investment. By making money cheaper to borrow, businesses can expand, and consumers are more likely to spend, leading to overall economic growth. Interest rates play a pivotal role in dovish policies. Lowering interest rates reduces the cost of borrowing, which can spur both consumer spending and business investments. This, in turn, can help reduce unemployment and boost economic activity. A key objective of dovish policies is to achieve full employment. Central banks may implement measures to support job creation and reduce unemployment rates. This often involves stimulating demand in the economy through various monetary tools. Dovish central banks tend to have a higher tolerance for inflation, especially if it means achieving other economic goals such as higher employment and growth. They may be willing to allow inflation to rise above target levels temporarily if it helps to support the overall economy. Hawkish policies are primarily focused on controlling inflation. Central banks adopting a hawkish stance prioritize price stability and are more likely to raise interest rates to prevent the economy from overheating and to keep inflation in check. Hawkish central banks often increase interest rates to control inflation. Higher interest rates make borrowing more expensive, which can reduce consumer spending and business investments, thus cooling down an overheated economy. Hawkish policies involve tightening monetary conditions. This can include reducing the money supply or increasing reserve requirements for banks. These measures are designed to curb excessive growth and prevent inflation from rising uncontrollably. Maintaining financial stability is a core principle of hawkish policies. By controlling inflation and preventing asset bubbles, hawkish central banks aim to ensure a stable financial environment that supports sustainable economic growth in the long term. Dovish policies are generally associated with higher GDP growth. By lowering interest rates and stimulating spending, central banks can boost economic activity, leading to increased output and growth. One of the primary goals of dovish policies is to reduce unemployment. By fostering economic growth and encouraging business investments, these policies can help create jobs and lower unemployment rates. Lower interest rates make borrowing more affordable for consumers, leading to increased spending on goods and services. This boost in consumer demand can drive economic growth and reduce unemployment. Dovish policies can stimulate business investments by making financing more accessible. Lower borrowing costs encourage businesses to invest in expansion, research, and development, contributing to overall economic growth. Hawkish policies are designed to control inflation. By raising interest rates and tightening monetary conditions, central banks can prevent excessive price increases and maintain price stability. Hawkish central banks typically raise interest rates to cool down the economy and control inflation. Higher interest rates can slow down borrowing and spending, leading to lower inflation. Bond yields often rise in a hawkish policy environment. Higher interest rates increase the return on bonds, making them more attractive to investors. This can lead to higher borrowing costs for governments and businesses. Hawkish policies can lead to a stronger currency. Higher interest rates attract foreign investment, increasing demand for the domestic currency and driving up its value. Just a quick reminder to please hit the like button and subscribe to the channel. Also, visit us on the web at www.investmenttees.com and use code BLOG to receive 25% on your next purchase. Central banks play a critical role in managing economic conditions through their monetary policy decisions. Their mandates typically include promoting economic growth, controlling inflation, and maintaining financial stability. Central banks implement dovish and hawkish policies through various monetary tools, including interest rate adjustments, open market operations, and quantitative easing or tightening measures. A central bank is considered dovish when it prioritizes economic growth and employment over controlling inflation. This typically involves lowering interest rates and implementing accommodative monetary measures. Hawkish policies generally involve raising interest rates to control inflation and maintain financial stability. Higher interest rates make borrowing more expensive, reducing consumer spending and business investments. The risks of dovish policies include potential inflationary pressures, asset bubbles, and long-term financial instability. Central banks must carefully balance the benefits of growth with the risks of rising prices. Investors can prepare for a hawkish policy environment by diversifying their portfolios, focusing on safer investments such as bonds and dividend-paying stocks, and staying informed about central bank signals and economic indicators. Political changes can significantly influence central bank policies. Governments may pressure central banks to adopt dovish or hawkish stances depending on their economic priorities and political agendas. Financial markets closely monitor central bank policies and react accordingly. Dovish policies can lead to stock market rallies and lower bond yields, while hawkish policies can cause stock market declines and higher bond yields. Investors closely monitor central bank signals to adjust their investment strategies. Dovish signals often lead to increased stock market investments and lower bond yields, while hawkish signals can lead to stock market sell-offs and higher bond yields. Investors use various strategies to navigate different policy environments. In a dovish environment, they may focus on growth stocks and higher-risk investments. In a hawkish environment, they may prefer safer investments such as bonds and dividend-paying stocks. Historical data shows varying investment performance in dovish and hawkish policy environments. For example, stock markets tend to perform well during periods of dovish policies, while bond markets may perform better during hawkish periods. Conclusion: understanding the difference between dovish and hawkish policies is essential for grasping how central bank decisions impact economic growth, inflation, and overall financial stability. By exploring the principles, effects, and real-world applications of these policies, we gain valuable insights into the complex world of monetary policy and its profound effects on the global economy. Thank you for watching.